It's April. You just opened your tax bill, and your stomach drops. $12,400. You made good money this year, so why does it feel like the IRS just mugged you? Here's the truth. It's not because you made too much. It's because of one invoicing mistake almost every freelancer makes, and it's silently draining thousands from you every single month without you even noticing. If you're a freelancer, a contractor, or you run a small business where you send invoices and get paid client by client instead of one steady paycheck, this video is for you. Not for someone with a 9 to 5 and a W-2. This is about people who run their income like a business, whether they realize it yet or not. By the end of this video, you're going to know exactly what this invoicing mistake is, how to fix it in the next 10 minutes, and how to build a system so that tax season never blindsides you again. This isn't about saving a few bucks. This is about never feeling that April stomach drop again, about having total control over your money, no matter how unpredictable your clients are. Let's be honest about what freelance life actually feels like. One month you invoice $9,000 and feel like a genius. The next month, 2 clients pay late, one ghosts you entirely, and you're covering rent with a credit card. There's no HR department withholding taxes for you. No steady paycheck smoothing things out. Just you, your invoices, and whatever's left in your bank account after you pay yourself, pay your expenses, and hope you set aside enough for taxes. And here's the part nobody warns you about. Every time you send an invoice and get paid the full amount, with no split, no separation, no system, you are quietly setting a trap for your future self. That money looks like yours to spend, but a chunk of it was never yours to begin with. It belongs to the IRS, to your future slow months, to your business's survival. And if you don't separate it the moment it lands, you will spend it. Not because you're irresponsible, because that's how money works when it all sits in one pile. This is the invoice mistake. Treating every dollar that hits your account as spendable income, instead of splitting it the second it arrives. And it's costing freelancers thousands every April, not from bad luck, but from a broken system. Let's fix this. Here are the steps. Step 1. The invoice split rule. What to do? The moment a client payment lands in your account, before you touch a cent of it, split it into 3 destinations: a tax holding account, an owner's pay account, and an operating account for business expenses. Why it works? This removes decision-making from the moment you're most tempted to overspend, right after a payment lands and you're feeling flush. You're not trusting future you to remember to set money aside. You're automating the split before the money ever becomes spendable in your mind. Quick example, you invoice a client $5,000. Instead of that $5,000 sitting in your checking account waiting to be spent, you immediately move $1,500 to tax holding, $500 to operating expenses, and $3,000 to owner's pay. Now your checking account balance actually reflects money you can spend, not a number that's lying to you. Step 2. The percentage-based tax bucket. What to do? Set a fixed percentage for most freelancers, somewhere between 25% and 30% depending on your tax bracket and state, and move that percentage of every single invoice into a separate, untouched savings account the day you get paid. Why it works? Quarterly taxes stop being a mystery when they're not a calculation you do in a panic every 3 months. They're just money that's already sitting there waiting because you set it aside as it came in. Quick example. You freelance and bring in $60,000 this year in scattered invoices. If you've been sweeping 28% into your tax bucket every time you got paid, you'll have roughly $16,800 sitting there when the bill comes, instead of scrambling to find it in April or worse, not having it at all. Step 3. Pay yourself like an employee, not like a leftover. What to do? Set a fixed salary you pay yourself from the owner's pay account on a regular schedule, weekly or bi-weekly, regardless of how invoicing is going that particular week. Why it works? This breaks the feast-or-famine cycle. Instead of your personal spending rising and falling with whatever client happened to pay that week, you create a steady, predictable income for your household, even though your business income is anything but steady. Quick example. Some months you invoice $8,000, some months $3,000. But because you're paying yourself a flat $2,800 every 2 weeks from your owner's pay account, your personal life never feels the chaos your business income actually has. The business absorbs the volatility. You don't. Step 4. The buffer account for slow months. What to do? Build a separate reserve, outside your regular accounts, that holds 1 to 3 months of your baseline personal pay. Feed it a small percentage of every invoice until it's full. Why it works? This is what actually ends money panic. When a slow month hits, and it will, you're not spiraling because you already built the shock absorber before you needed it. Quick example. You need $2,800 every 2 weeks to cover your life. If you've built an $8,400 buffer, that's 3 full pay cycles you can survive with 0 client payments coming in. That's the difference between client ghosted me being a minor inconvenience versus a financial emergency. Step 5. The weekly 10-minute money check-in. What to do? Once a week, spend 10 minutes looking at your 4 accounts: tax holding, operating, owner's pay, and buffer, and just confirm the splits happen correctly and the numbers make sense. Why it works? This isn't bookkeeping. It's a control ritual. It's the thing that turns, "I have no idea where my money is," into, "I know exactly where every dollar is," every week, without fail. Quick example. 10 minutes once a week, 52 times a year. That's under 9 hours a year to never be blindsided by taxes again. Compare that to the hours of stress, the panicked Google searches, and the credit card debt from an unexpected tax bill. Think about a freelance graphic designer. Let's call her the Invoice and Hope Freelancer. For 2 years, every payment went straight into one checking account. She spent based on vibes. Some months felt amazing. Then April hit and she owed $9,000 she didn't have. She put it on a credit card at 24% interest and spent the next year barely climbing out. The next year, she implemented this exact split system. Same income, same clients, same unpredictable months. But this time, every invoice got split the moment it landed. When April came around, she didn't panic. She transferred the tax bill from an account that already had the money sitting in it, calmly, like paying any other bill. Same business, same income, completely different relationship with money because the system changed, not the income. Here's the truth. You're not bad with money. You're running a business without a system a business needs. Employees don't think about taxes because someone else handles the split for them. As a freelancer, you have to be your own payroll department, and that means splitting every invoice the moment it lands, building your tax bucket automatically, paying yourself like a steady employee, buffering for slow months, and checking in weekly. Do that, and April stops being a month you dread. It becomes just another Tuesday. If this is the first time you're hearing this system explained this clearly, hit subscribe because this channel is entirely built around helping freelancers and small business owners get real financial control, not generic advice that doesn't apply to your income. And before you go, comment below with your invoice split percentage, or if you don't have one yet, comment, "I need a system," so I know to make more videos like this. Next week, I'm breaking down exactly how to calculate your specific tax percentage based on your state and income bracket so you're never guessing again. Subscribe so you don't miss it.